Could Palantir be the next NVIDIA? Palantir stock has absolutely skyrocketed in recent years. The company is growing at an amazing clip, and suddenly, everyone is asking the same and most logical question I can imagine. Is it too late to buy, or is this just the beginning for this incredible stock? Now, we understand why people chase the next big winner. Nobody, and I really mean probably nobody, wants to miss out on an opportunity like NVIDIA. But that's also where speculators and investors together can get themselves into trouble, buying great stories at the wrong price. And that's where we step in as a channel. We are here to help you make sure that you don't set yourself up for failure. But before we go any further, I want to set very clear expectations for this video. If you are brand new to investing, don't worry. We're going to start simple and make sure we don't lose you along the way. It will be confusing. That's okay. It's been confusing for all of us, including Warren Buffett at some point. If you stick with it, I assure you, not only will you understand it better, you will be a better investor because of it. And if you're more experienced, stick with us. I promise we're going to go deep onto Palantir. As the video goes on, we will slowly turn up the heat, getting more detailed, getting more analytical, and more technical about the future of this company. So that way, there'll be something in this video for every level of investor. Now, here is the other important thing to remember. We understand completely why people are chasing Palantir. We have all been there. When a stock runs hard, when the narrative clicks, it creates one of the most powerful emotions in investing, the fear of missing out, the FOMO. And FOMO really just means that you're human. That's it. But our job as investors isn't to chase what's already happened, isn't to chase a little price going up and down. Our job is to figure out what's going to happen next based on the fundamentals. Is the price today giving us an opportunity to buy with an ample margin of safety for the future? So before I explain that further for those of you who are new, it's very simple, and I love Warren Buffett's analogy. If you're an engineer and you're told to build a bridge that can hold a 10,000-pound truck, you do not build a bridge that holds a 10,000-pound truck. You build a bridge that can hold a 20,000-pound truck because you need to have a little bit of margin of safety in there. What if the truck puts a few more things on there that you're expecting? What if there's a little crack in one area of the bridge? That's the same for investing. We don't invest in companies assuming everything goes perfect. We assume a normal path of the future, and we hope for better. Now, let's start with the story of Palantir. To truly understand why Palantir has people asking if it's the next NVIDIA, you first have to understand the path it took to get there, because this stock didn't go straight up. When Palantir went public, expectations were absolutely sky high. The company was mysterious. It still is mysterious to a certain element today. It was deeply tied into the government, pretty much all government, and positioned as this elite data platform that solved problems nobody else could see or solve. The story was powerful, but the price ran way ahead of the business. Revenue growth wasn't fast enough to justify the valuation, but that only mattered to people who understood that. Stock-based compensation became a major concern. What does that mean? It means when the company's trying to recruit people, they're giving them stock as compensation. Well, guys, that's diluting. That's basically an expense. So when you have a bunch of cash flow coming in, but you're issuing stock outward, that's basically a net change of zero. Profits felt distant. And once the market shifted from growth at any price to show me the cash flow, Palantir got crushed. The stock didn't drift lower. It collapsed. Shares fell from a high of $45 in 2021 to a low of $5.90 in late 2022. Sentiment flipped completely. In fact, we have a video back from February or March of 2021 where we said we'd be interested in the stock around 5. Now, it just happened to work out that way. I'm not trying to pretend like I'm some guy who sat there and said, this is where it's going. I just sat there and said, this is where I'd be interested in looking at the company. But what once felt like the future of data AI became overhyped, uninvestable, and to us became dead money. Most people gave up on it right when the business was about to break through. And that's the key point. The recovery didn't start because hype came back. It started because the business began to improve and the hype started to build again because of that. Costs came under control. Profitability showed up in a major way. Commercial revenue accelerated. That was their big thing. They were all government and they said, we're going to expand to commercial. That combination, improving fundamentals and a powerful narrative, is what fueled the stock's surge. And now, after a massive run, we need to look deeper to make sure speculators haven't driven this price to extreme levels like in 2021. So let's talk about that carefully. When people compare Palantir to NVIDIA, they're anchoring to what just happened. It's a recency bias. In late 2022, we had just finished off what we now know is a finish off of a bad tech bear market. The NASDAQ was down 30+%, and NVIDIA was a big part of that. The stock was down big from over $30 per share to as low as $14 per share. But then AI, artificial intelligence, went from concept to reality. NVIDIA wasn't just a chip company anymore. It became the infrastructure layer for artificial intelligence. Revenues exploded, margins expanded, earnings shocked the market, and the stock didn't just recover, it exploded to over $210 per share. That's the part that people remember. So when investors look at Palantir today, they see some similarities. A stock that was crushed and left for dead, a business tied directly to AI and improving profitability. Emotionally, it feels similar. But this is where investors need to be careful. NVIDIA's run wasn't just about a good story. It was about extraordinary growth, massive operating leverage, and a near monopoly position at exactly the right moment of time. NVIDIA's growth is something basically never seen before for a company of that size. Which brings us to the next step. Not what we think, but what everyone else is saying right now. Now, one of the most talked about voices in the market right now when it comes to Palantir is not a bullish analyst. It's Michael Burry, the famous investor from The Big Short. Now, Burry has publicly taken short positions against both Palantir and NVIDIA recently, purchasing put options that will profit if their share prices fall significantly over the next few years. A quick recap of what that means is he buys an option for a much lower price in the future. Let's say $50 a share. If it goes below 50, every dollar it goes below 50, he makes $1 per share. Now, why has he done this? Well, he has said that he sees the current enthusiasm for AI stocks as potentially detached from reality, drawing parallels to past bubbles where narrative outpaced fundamentals, something we talk about all the time. In his view, both NVIDIA and Palantir may be priced for perfection, and that historically, that is a dangerous place to be. I want to make a couple caveats here. $10 million bet. A lot of people have him out there saying, oh, you made $1 billion bet. No, that's if you took all of his position, all the shares, multiplied them out. His bet was $10 million. That's the cash out of his account. That's how much he stands to lose if it doesn't work out. If it works, he could make many times this. That's one. Two, yes, Burry, and I'm glad to be in the same boat as him, has called for overvaluation for quite some time now. And of course, people say, see, he doesn't get it. Guys, when all these great value investors who've done well over the long haul, including me before this big COVID run up, I sit there and go, at some point you got to sit there and say, who's more likely to be right here? All these guys have been right for decades, or Billy, the 17-year-old pimply kid next door who's going YOLO on Palantir and Bitcoin? Do you really want to be on the side of Billy? Or Buffett, Munger, Klarman, Howard Marks, Michael Burry? And for those of you who don't get that, I'm not telling you just because they say it, they're right. But all these guys are saying very similar thing. Now, this stance that he has not gone unanswered. Palantir CEO Alex Karp publicly criticized short sellers like Michael Burry after the company reported strong revenue, calling out critics for betting against what he sees as one of the best businesses in the world. Alex Karp doesn't get it. People take the short selling as this company's a bad company. Some cases, that's the way it is. People will say, this is a terrible company, I'm shorting it. That's not the case. This is price and value being disconnected. If you take it personally, that says more about you than it does about Michael Burry. Now, on the other side of this argument is billionaire Ken Griffin. For those of you who don't know, Ken Griffin is a multi-billionaire who runs Citadel Advisors, one of the most successful hedge funds in history based on their net gains since inception. He was heavily involved in the meme stock craze that we saw a few years back, but denied accusations that he colluded with Robinhood to restrict trading. More importantly, in this past third quarter, Citadel sold 1.6 million shares of Amazon and purchased 388,000 shares of Palantir, which, as we know, is up over 1,000% since January of 2024. Now, guys, comparatively, NVIDIA is up 281% over that same time period. This article points out that Palantir is the most expensive stock in the market, trading at, and I'm going to explain what this means, trading at 119 times sales. What does that mean? Well, guys, whenever you buy a company in an industry, a way to compare value is to compare the company's price to sales ratio. So for example, in the car industry, the average car company sells for 0.5 to 1 time sales. So if a car company does $100 billion in sales, they'll be valued at $50 to $100 billion. Why do we think Tesla's overpriced? Well, over 90% of their revenue comes from cars, and they're selling for like 13 times sales. A company like Microsoft, which is probably a little frothy in terms of its valuation, is selling for like 12 times sales. Palantir is selling for 119 times sales. With that said, Palantir does have more growth potential than Microsoft, but enough to justify 10 times more sales? I don't know. The second closest stock trades at 45 times sales. Take that in for a second. That means Palantir could fall 60% and still be the most expensive stock in the index based on price to sales. We will talk about this more later, but for now, let's really get into what this business does. So let's start this very simple, and we will add to it as we go. To start, imagine you're running a huge organization, like a government agency, like the military or hospital system. You have data everywhere: spreadsheets, databases, emails, aging systems that do not talk to each other. None of it is connected. And trust me, when you need to make an important decision, you don't want to deal with slow, scattered reports. This is where Palantir comes in. At its most basic level, Palantir helps organizations take messy data and turn it into clear data to make clear decisions. So instead of constantly guessing, leaders can see what's happening in real time. That's why Palantir works heavily with governments, defense agencies, law enforcement, and Fortune 500 companies. Now let's add another layer. Palantir software isn't something you download and can cancel next month. Once it's installed, it becomes deeply embedded into how an organization operates. That creates two important things. First, very high switching costs. It's very expensive to uninstall and switch to a different provider. Second, long-term contracts, providing a clear path to revenue and profit for years to come. So Palantir has two main parts of its business: government, defense, intelligence, national security, and then commercial, large companies using AI and data to improve operations. So for years, government contracts were the full backbone of the company: stable, sticky, but not explosive. What's changed recently and why the stock has run is that commercial side has absolutely exploded. Palantir software sits on top of a company's data and helps deploy AI in a very secure way. Now, we have heard why Palantir is being compared to NVIDIA, what moves big investors are making, and what we understand what the business actually does. The next step, the most important step, is to figure out if it's a good value today. And the honest answer is this: it depends, not just on the company, but on the price you pay. This is where a lot of investors get very tripped up. When a stock has already gone up a lot, people start thinking, how much higher can it go? That's speculation. Investing is different. Investing is about understanding what a business is worth based on the cash it can generate over time, and then compare that price to what the market is offering you today. So your job as an investor is to determine a price for the business, and then once you've determined that price, the value of the business, look at what the price the market's selling at. Are you a buyer? Are you a seller? This is why the next step is actual analysis. So we're going to pause the narrative here and do exactly this. So here's Palantir right now. It is a $446 billion company. Now, guys, their enterprise value is less, which means they have more cash on hand than debt. That's a very good balance sheet. That's very difficult to go bankrupt when you have more cash on hand than debt. Another thing I love, their net income was $1.1 billion last year, but their cash flow was $1.8 billion. Higher cash flow than net income. And the 5-year average, $730 million in 5-year free cash flow. And net income in the last 5 years, $130 million. Guys, they're currently selling for 250 times free cash flow. 250 times free cash flow. The market average, 15 or 16. Great companies should probably be around 20, maybe a little bit higher. This is the question here. So let's look at the 8 pillars. A lot of X's, doesn't mean you should avoid it, but return on invested capital, 5-year is negative 13%. A little misleading because their cash flow has greatly increased. It's positive in the last year. Guys, they're diluting their shareholders. They are issuing shares. Why? Because the shares are expensive. And when shares are expensive, a smart thing for a company to do is give crack to the people who are addicted to crack. Palantir is the crack. So all they're going to do is say, oh, you guys want Palantir at any price? Here you go. Give us the cash. We'll take it. But this is hurting the investors who believed in it all along. Obviously, everything else is up. Revenue, profit, free cash flow, debt is low. But look at these metrics. 3,400 times 5-year earnings, 607 times 5-year free cash flow. Let's see what analysts think. Okay, remember, earnings are less than free cash flow, but they have earnings at 87 cents a share this year, growing to 224 in the next 3 years, which is 30% plus a year. And revenue growth, 37%, 33%, 45, and 33%. So analysts believe they'll be doing around $15 billion a year in revenue in the next 4 years. Pretty freaking awesome. Now, if you're new to our channel and all these numbers feel overwhelming, you're not alone. Like I've said before, it's overwhelming for everybody at some point. We're here to simplify all of this. So what I want you to do is, if you're interested in understanding some of these key metrics, these are the important metrics to understand of a company. When you're looking at them, click the link below. We will email you our key metrics PDF. It'll send you an explanation of all of these metrics and why they're important. And this is exactly why I teach on YouTube, because I know that everybody's capable of being a better investor. And I know there's a lot of junk out there from other YouTube people who say they're investors, but just follow stock price. It makes no sense whatsoever. What we're trying to do here is simple, not easy. This will make it a lot easier for you. So click the link below and we will email it to you right away. So guys, now we're here to determine what's the reasonable price to pay for Palantir. I am going to do a 10-year analysis on this. You can do up to 20 years on our stock analyzer tool. Now guys, remember, we don't know the future. The future is unknown. Our job here is to make assumptions about the future and then pay a price that gives us a good return on our capital. But Palantir is a young company. I mean, it's almost like 18, 19 years old, maybe even 20, but its history in the stock market is not very long and it's growing like crazy. So we don't know what the future looks like. Look at this. In the last 5 years, revenue growth has averaged 31% a year. Profit has been 5.4 and free cash flow 30%. Look how different it is in the last 1 year. It's very different. So I made some absurd assumptions. I went 10 years and 30% a year in revenue growth. Just to show you how much that is, guys, let me show you. 1.3 to the power of 10. That is 14 times more revenue in the next 10 years. That's a lot. That's a whole lot. I don't remember the last time a publicly traded company that was valued at hundreds of billions of dollars was able to do that. That is a very difficult task. But that's kind of my point here. Profit margin, I put 35, 45, and 55, and same with free cash flow. I actually think that's kind of reasonable based on their high margin. So let's stick with that. PE. What's the PE 10 years from now? Well, its returns on capital are getting better. And if it keeps growing like this will be a massive company that's awesome. So I put in 18, 22, and 26. It deserves a premium. And then finally, I'm putting in my no margin of safety, 9% return to find out what the company is worth to me. Now remember, I'm not buying for what I think it's worth. I want to buy with a margin of safety. So I shouldn't have said what it's worth to me, what it's worth to the market. If you were to value it on the market's level, of course, if you want margin of safety, you have to increase this number to make sure you have that margin of safety, because the higher your desired return, the lower your price to buy it at. Hope is not a plan. I used to buy stocks hoping that they would go up, but hope doesn't protect you when the market turns. Hope doesn't help you sleep better at night. Hope it doesn't decrease your fear. I had to learn how to build a real strategy, one that makes sure that I personally never go to zero. Now, every investment I make is based on numbers, not hype. This is why I built Everything Money. It was built for me. I wanted the tools that gave me clarity, took the fear out of investing, and helped me make better decisions that helped me sleep better. People saw me using them on YouTube and said, Paul, can you give us that software? And I said, well, I can't because it's mine right now, but I can create it. And so I did, and a real community was born. Real people sharing ideas, live chats, live streams, and tools that help beat 99% of investors. I still use these tools like the stock analyzer every single day. Stop guessing, start learning. Click the link below, try our trial, $7 for 7 days, and see how confidence will replace your fear. So I hit the analyze button, and here's what I got, guys. I have a low price of 33, a high price of 300, a middle price of 105. Remember, this middle price assumed 30% revenue growth for the next 10 years. Let's go change that just a smidge. Let's make our revenue growth assumptions 12.5, 20, and 27.5% revenue growth, which is still a lot. I have a low price of 19, a high price of 122, and a middle price of 50. So guys, let's bring this all together. Palantir is a real business. It solves real problems, and it's showing real progress. But great companies don't automatically make great investments, especially after a big run-up like it's had. Palantir doesn't need to become NVIDIA to be successful, but today's price already assumes an NVIDIA-like outcome. So the margin of error has gone away, and it's gone completely. When Palantir was beaten down, the expectations were low. The market didn't believe in the story anymore, didn't believe the profitability was near, and didn't trust in management's execution. That created an opportunity for investors who are willing to look past the noise. And that's the key lesson. You do not build long-term wealth by chasing what already happened. You build wealth by understanding price versus value, being patient, and waiting for opportunities where expectations are low because discipline matters most. And just like people exaggerate the upside, they will exaggerate the downside. If Palantir continues to execute at the highest level and manages to grow into its current sky-high valuation, awesome. If not, though, I promise you, there will always be another opportunity. There always is. I've seen it over 30 years of investing. The market will always offer you more opportunities in the future, so don't get caught up in the FOMO. So if you want to see the companies that do fit my process, I picked 7 stocks that I believe can beat the Magnificent Seven. And I'll be honest, last year's results were not what I expected. You're going to want to see who made the list. So click the video on your screen right now, and I will see you there. Thank you for your time.